Hello and welcome back. We're on chapter 2. I think I'm going to do 3 videos for chapter 2. The first video will be debits and credits part 1, then we'll do debits and credits part 2, and then we'll look a little bit more at the accounting cycle and the trial balance in the third part. So moving on to debits and credits, let's go ahead and see what we've got for this evening. So where we left off on chapter 1 was we were talking about financial statements. And we were talking about business transactions. And remember, we're at the point where we've looked at the 4 financial statements: the income statement, the statement of owner's equity, the balance sheet, and the cash flow statements. And we have all this information on those statements, but where does that information come from? Well, it comes from the accountant putting together all the business transactions during the month, the quarter, the year, whatever the period is, putting those transactions together, recording them as accounting information, and then summarizing them and putting them in the financial statements. So that's what we're working on. We're working on how to take individual business transactions and convert them into accounting information so that they are ready to be put into the financial statements. So let's take a look at the rules that we had initially set out when we were trying to talk about business transactions last on the end of chapter 1. And so the 2 rules, or there are 2 guidelines, were 1, at least 2 parts. There are at least 2 parts to every transaction. Number 2, we are going to rely upon the accounting equation to make sure that we have entered it correctly. The accounting equation must balance afterwards. And just to remind ourselves, the basic accounting equation, the basic one that we're going to use for this segment, is assets equals liabilities plus equity, or owner's equity. Now, we are talking about debits and credits, and this is going to allow us to take the next step in looking at business transactions. We looked at a little bit in chapter 1, but we're going to take it to the next step. Now, notice that we have here two parts of every transaction. So debits and credits, and we're going to abbreviate those DR and CR. Debits and credits, well, these are the 2 parts. The 2 parts are going to be a debit and a credit. So we can sort of further define rule number 1 is at least 2 parts to every transaction, and there must be a debit and a credit. And not only that, that all the debits must equal all the credits. Well, we still don't know what a debit or a credit is, so let's take a look at that. So remember, we're going to be using debits and credits as a way to record business transactions. And how we've been looking at the business transactions in one format so far. So the first format was the accounting equation. And we're going to look at, over the course of chapter 2, 3 more formats. There's going to be a second format, and it's going to be called the T account. And it's going to be using debits and credits. The journal entry, it's also going to be using debits and credits. And the last one is going to be the trial balance, which will also use debits and credits. So the accounting equation, we got away with just talking about increase to cash or decrease to cash, but now we're going to define things rather than increases or decreases as whether they're a debit or credit. Here, trial balance. So let's first look at a T account. It's nothing mysterious. Why do we call it a T account? Because it looks like this. It looks like a giant T. And depending upon the type of account that we're looking at, the type of account will be written at the top. Now, what does debit and credit mean with respect to the T account? Let me move this back here a little bit. The debit and the credit only, and this is important, to not get ahead of yourself and think of debits and credits as pluses or minuses yet. The only thing that we want to consider a debit or credit as is whether or not which side of the T account it is on. So a debit side is always the left side. So it's always the left side. And the credit account, or the credit side, is always the right side. That's all it means. So how do we use this with regards to recording business transactions? Well, let's bring back our assets equals liabilities plus equity. And I'm just going to use the basic equation for part one, and then we'll expand it in part two. So for all the different assets, and I'm just going to put assets as a T account here, all the liabilities, all the various liabilities, all the various equity accounts, they're, no matter where they are on the accounting equation, the debit side is also always going to be the left, and the credit is always going to be the right. Now, this is where things get a little tricky. Situationally, the positive side, or the side that increases the account for assets, is the debit side, and the credit side decreases. But it's the reverse over here. The credit side increases. In other words, any numbers that we enter on the right side of the account are increasing, and any numbers we enter on the left side are decreasing. And one way you can look at it is, if it's on the left side of the accounting equation, then the left side of the T account is the increasing side. If it's on the right side of the accounting equation, then the right side of the T account balances. Now, this is one of those things that at some level there, you may try and figure out a type of logic to it, but it is actually just sort of a baseline rule from which we build the internal logic on top. So this is like learning to play a board game or learning to play music. At some point, it's just, this is how it is. And from here, we can kind of explain everything. So at this point, just understand that for assets, debits are increasing, and for liabilities and equity, credits are increasing. So let's take a look at a number of business transactions, and let's try and define them using the accounting equation, but also using debits and credits. So the first business transaction we want to do is an owner invests money in the company, invests cash in the company, and let's say it's $2,000. Well, here, the particular asset account is going to be cash, $2,000. But now we have to decide. Previously, we had an up and down arrow, right? We said it was an increase to cash or it was a decrease to cash. But now we're going to use the more accounting-like terms and to say, is this a debit to cash or is this a credit to cash? Well, because this is an increase to cash, we're going to say this is a debit to cash. And on the other side, we still have to follow the rules. The accounting equation must balance, and the debits and the credits must balance. So on this other side, we have owner's equity or owner's capital. And this is also going up by $2,000 because owners now have a $2,000 claim on the assets of the company. So if owner's capital goes up, is that a debit or a credit? Well, for equity accounts, an increase is a credit. So here we have, let's check our rules. Does the accounting equation balance? Yes, there's something on each side, and my debits equal my credits. Now let's go ahead and follow through and put this in this is the accounting equation format. Let's put this in the journal entry in the T account format. So if I was to put this in the T account, this would be cash, increase of 2,000. This would be owner's capital, and it would be on the credit side. If I was to write the journal entry, so what is a journal entry? The journal entry is essentially taking the accounting equation information and making a small bookkeeper's entry. Now, how do we do that? Let's say you have an imaginary, line. Now, when we write a bookkeeping entry, what we do is we can use debits and credits. The debits go before the credits. And we write here, debit cash, 2,000. And I would indent the credits. Credits would go second, and this would be the owner's capital, and 2,000. Now notice the debits go first, the credits go second, and then the account titles, and then the numbers are in their own columns. For example, if we had a whole bunch of journal entries, all the debits would be in a row and all the credits would be in a row. Let's look at a second journal, a second transaction. Let's say we take out a bank loan for $1,000. Well, what happened to cash? Cash went up. So we would say cash 1,000 debit. And the other part of the transaction would be we have an increase to a liability. We have an increase to an obligation. And an increase to a liability is a credit, and that would be a bank loan. And instead of calling it a bank loan, let's call it the proper accounting term, and that would be a note payable. And that would be also 1,000. If I were to put this as a journal entry, it would be debit cash 1,000, credit note payable 1,000. Well, I tried to get it in line. My T accounts would be cash. If I were to follow on from here, I would say this one would be an additional 1,000 in cash. And then this T account would be for a note payable, which would be a credit amount of 1,000. Let's take a look at a third one. This one is going to be, let's buy some equipment with cash. And the equipment is going to be, how much should I put here? $1,100. Well, now cash is going to go down, right? Cash, we spent cash to buy equipment. So cash goes down. And what does that mean? Well, cash is an asset. That means an asset goes up with a debit and down with a credit. So if we have cash going down, we have a credit to cash of $1,100. But we also have another asset that's going up. We bought equipment. And when equipment or when an asset goes up, we debit that asset. So here's a debit to equipment for $1,100. Now notice nothing happened on this side. Nothing happened on this side because all of the changes were an increase of an asset and a decrease of an asset. If I were to write the journal entry, again, I'd put the debit first. Oops, not that extra one. Credit to cash, $1,100. If I were to enter that into my T account, I had an increase of 2,000 because of the investment, increase of loan for 1,000, and then on the credit side, I would write, this would be a decrease to cash. If I had an equipment T account, it would be an asset, and it would be an increase of 1,100. Let's look at two more. Let's look at, so number 4, buy inventory on account. So we still have the assets equals the liabilities plus equity. And remember, for assets, debit increases, for liability, credit increases, and for equity, credit increases. So we buy inventory on account. Well, do we mean by on account? That means we take possession of the inventory. So we've purchased it, but we promised to pay them later. Essentially, we give them an IOU rather than giving them cash. So we don't give them any cash, but we do increase our inventory account. Inventory is an asset. So I would debit inventory. Well, I didn't say how much, did I? Let me check. It's debit. We're going to buy $500 worth of inventory on account. So I would debit inventory 500 and just lost the screen there for a second. Let's see, is it still recording? Yes, still recording. Sorry. I didn't refresh my screen. Oop, and now we're going to lose some of the, there we go. Okay, sorry for that. My screen, I'll have to remember to touch something on the screen to make sure it keeps going. So we debit inventory for 500 and then we promise to pay them later. Well, that is what we call an accounts payable, 500. And remember, we increase a liability through a credit. So do my debits equal my credit? Does my accounting equation balance? It does. If I were to write the journal entry, it would be debit inventory 500, credit accounts payable for 500. And you can think of accounts payable as an account for cash to be paid later. So here's the A and the P, account payable. And remember, it's for cash, right? It's a substitute for cash. In other words, we don't pay cash now, we pay it later. And my T accounts would be, well, I had an inventory. It increases with a debit. And then I'd have an AP, which increases with a credit. Let's look at the last one. It's going to be, let's say we bought this inventory on account, right? So we haven't paid them, but we promised to pay part of it at the end of each month. So let's say we get to the end of the month, and we want to pay part of our account. And that's going to be, let's say we pay $100 on it. Well, here under the assets, let's say we pay $100. So that's going to be credit to cash because cash is going down by 100. But also my AP is going down. Well, remember on the AP side, that's a liability. A credit increases, therefore a debit decreases. So debit AP 100. So what happens is cash goes down. I'm not going to bring over the amounts from the other side. I'll just show it as new. But here we started off with an accounts payable of 500. We paid down 100. So how much is left to pay? 400. Okay, so that's the basics of debits and credits, at least with the basic equation. We're going to go ahead and look at an expanded version where we start talking about revenues and expenses and adding in sales to customers to this equation. Okay, talk to you soon. Thank you.